Swayam Prabha. Digital India. Educated India.
Hello and welcome to the 10th lecture in the series on Fintech. My name is Dr. Sudhindar Hanumanta Rao. I am the Dean of Faculty of Management and Commerce at Manipal University in Jaipur. Today we will look at two topics. One is micropayments, which spilled over from the previous lecture, and to close the series a little bit of a look at the regulatory landscape. How Fintech is being regulated, what are the ideas, because Fintech is something new. Oftentimes what Fintech does didn't exactly fit into the regulations of either information technology or finance for that matter. So, how are the regulators responding to that? What are the changes in place, what changes have already happened, and what its effect, and we will see some examples of that. First, let us begin with micropayment. What is a micropayment? A micropayment is a financial transaction involving a very small sum of money, and usually one that occurs over the mobile online, and sentence got cut off, online, sorry, it is not, it has got whited out, I do not know why, apologies. Usually one that occurs online and most of the times on the mobile platform. Most of us must have seen this scene. Somebody selling pani puri on the side of the road has a sign saying that he will accept a P2P payment using Paytm, Google Pay, what have you. Think about it. In many cities, especially in Jaipur where I stay, to my delight I found that it is so inexpensive. A full plate of it may cost just 10 bucks, 10 rupees for a plate of this. Even that I can pay online using this system, Paytm. Likewise, you might have seen street side vendors accepting Paytm for vegetables, for coconut water, small things where we could never imagine anything but cash. But those transactions have gone online today, and good that they have entered the legal transaction system, unlike cash which goes undocumented. Now, every transaction, one even worth 10 rupees, which was not feasible with previous methods like credit cards. So, cash was the only recourse. Now, they all have moved towards online using this system of micropayments. So, by micropayments we mean small payment, 10 rupees, 20 rupees, 50 rupees, which either we dealt with cash, now we are dealing with them with micropayments. This is the opportunity for micropayments across the world. It is taken from a report from World Bank. It estimates that in South Asia, the potential for all micropayments is about 4 trillion, of which about 20% of it could be transferred to P2P systems. These are the numbers. In East Asia and Pacific, the number is 9.5 trillion potential, of which 31% is amenable to micropayments. Europe and Central Asia 3.1 trillion, 46% is amenable to micropayments. In OECD, the high income countries, the potential is $11 trillion, of which 71% is amenable to micropayments. Like that, globally, the World Bank has estimated that the size of this potential for micropayments is about 34 trillion, of which about 44%, 15 trillion is amenable to our micropayment systems using P2P, mobile and other different platforms. So, they actually have estimated as micro and small to medium enterprises. These are the estimated values as in 2015. Whichever measure you use, the potential of the business is enormous. About that, no question. So, this we saw, it is a financial transaction involving a very small sum of money, usually the one that occurs online. What is the problem in handling micropayments? Why do we have this new concept called micropayments, which was not there earlier? So, obviously, we could not implement it earlier because of certain issues and problems. So, let us look at some of those, take a look at some of those limiting factors. One is the value of transaction is too small. So, the old systems like credit card, debit card, online payments, the cost of transaction is high enough. In the case of credit card, we saw that the credit card network may charge between 2 to 5% of the cost of the transaction per transaction. It is a significant number, 2 to 5% of the entire transaction being charged to do that transaction. So, it is not worthwhile for all the parties involved to do micropayment for very small amounts, because in which case if the amount is too small, these networks may charge a fixed amount. They may say 5 rupees per transaction. If my entire transaction is for 10 rupees and if 5 rupees goes away in fee, what is the potential for making any profit in that business? So, size of the transaction was too small. That was one of the limiting factors in the traditional systems. Second, the volume of transactions is very high. Imagine all roadside vendors today are accepting one of these platforms, whether it be Paytm, MobiKwik, PhonePe, M-Pesa, Google Pay, Amazon Pay, what have you, one of these wallets and things like that. So, earlier credit cards were limited to limited number of customers using it limited number of times. We have 57 million credit cards in India. If each customer uses it 10 times in a month, we are looking at 570 million transactions. In micropayments across the country, so many transactions might be happening per day. So, the old systems were not scalable. They could not handle this increase in volumes which these new systems are. So, scalability was a problem. The fixed cost of handling the transaction also was high. They were using their own networks, they were very secure, no doubt, not easy to break into them, not easy to commit fraud, like we have seen in the case of security measures provided by card providers, by SWIFT, various other traditional organizations. They are very secure, but providing that required a very heavy fixed investment, which again raised the cost of the transaction. Whereas, in the case of some of the new P2P systems, we already have mobile systems. Mobile systems are there to make mobile calls, but this technology leverages that, makes use of a infrastructure already in place to open up this huge avenue of transactions, huge opening for huge range of transactions. So, the fixed cost is much lesser in the case of mobile payments. Second, delay in making the funds available. Another feature you might have seen, the moment you pay that roadside sabji wala 50 rupees, 100 rupees, whatever it is, it gets immediately deducted from your account, gets credited to his account. It almost behaves like cash, whereas in one of the traditional systems, it can go for once per day in the case of credit and debit cards for the merchants, to taking a few days as long as a week using a check, whereas here funds are available immediately, which is what made them very popular with the merchants to accept them. And ease of access. What do each parties need? As you have seen, to accept a credit card you need that swiper. The merchants need to have that swiper. I need to have a validated card. I have to use the two. We have to set up the infrastructure for the card to be swiped, that information to be transmitted through various networks. Here, what is the setup cost? I already have a mobile. The sabjiwala also has a mobile. Both of us have to download the app. That's all. As simple as that. So, the setup is the cost of setup, the ease of setup is very high. And today all of us know how to download and install an app. Actually, we just have to download, it pretty much installs itself, it pretty much updates itself. So, ease of access, cost of setup, both at the point of the payers from the point of the sellers or merchants, is very high ease, very easy, and access is almost universal. And record keeping. So, all the transactions are recorded automatically. At any point I can go back and see what are the payments I made. I do not have to wait for my monthly payments. So, these were some of the problems in the old system. Our setup was very complicated, it was expensive, cost of infrastructure was high, there was a delay, and record keeping was centralized. Now, all of them have gotten decentralized. We have access at our fingertips to any of this information. That is how these new systems have solved some of the existing problems. But these were the problems in the previous systems which prevented them from implementing micropayments very efficiently. We will see one more factor, we will come to that later. But there are still some challenges. The new P2P, mobile based P2P systems have solved many of these problems, but there are still challenges. One is means of making money, at least recovering the cost from online content. We can make payments, we can make micropayments, but making profit has still been challenging because the size of transactions is too low. There are today an enormous number of transactions, and part of that is because prices are low. The cost per transaction, the price of items we buy using any of these e-wallets is low, but hopefully all these players in the fintech field, some of them have become profitable already. They are hoping that the high volumes will compensate for the low cost per transaction. And Another challenge, many of the content, we are talking about buying physical goods, but we can also buy content online, right. We can go to Netflix and download all the movies we want. We can subscribe to YouTube Premium. There are so many other sites where we have to, so many of the newspapers and magazines and all, if you want to read their articles, most of them give between 3 to 5 articles for free. Anything more than that, we have to go for a subscription. We have to pay them some X amount, $20 a month, 200 rupees a month, or whatever, 5,000 rupees a month, 2,000 rupees a month, a monthly or an annual subscription we have to pay. These P2P systems can convert that. The good thing about subscription is, if I subscribe, for the provider, it provides a predictable stream of revenue. If I subscribe at the rate of 200 rupees a month, if I subscribe for 1 year, the provider knows that they can expect 200 rupees regularly for the next 1 year. P2P systems are trying to convert on a pay per view. If I want to download one article, I only pay for that, and that reduces the volume of transactions per transaction. I only want to pay X amount using a micropayment, but for producers it is better to have a subscription or an aggregation. So, working in a challenge between this, letting people read one article or download one song out of a movie instead of downloading a suite of movies or one whole bunch of subscriptions per month. That is the characteristic which leads to the next one. So, if I buy subscription to Netflix, whether I like it or not, that so many movies and shows are available, I may not be interested. I may be interested only in mysteries, murder mysteries or action movies. So, now with micropayment, I can only download them and pay for that. So, from Netflix perspective, that is worse, because they have fixed cost. They would rather have a fixed subscription. I would prefer to download and watch only and pay for only what I like to watch. So, finding a balance between the two is a challenge. And now many customers, content creators, can go directly to customers. They do not have to use a channel. They have to go through Netflix, they do not have to go through Hotstar. They can simply create a challenge on YouTube and go for micropayments and charge per view. Every time somebody downloads some lecture of mine, I can charge 5 rupees instead of going for a subscription with one of these edutech platforms. And another challenge with most traditional currencies, micropayments, as I said, are meant for very small payments, but most traditional currencies are not divisible beyond a limit. For example, the lowest value of a US dollar is 1 cent, and today 1 cent is about 70 paise, which is not an insignificant amount. It is a small amount, but when we are doing a number of transactions, not insignificant. The dollar cannot be divided anything more than that. And in the case of rupee, 1 paise, which is again not many people may accept that. So, current currencies are not highly divisible. That is one of the challenges for micropayment, for them to make money also. So, there are two approaches. Fintech companies have taken two approaches to address this issue of micropayments. One is work with traditional channels. You know, credit card companies have a minimum required. If I use my credit card to make a payment of $2 or 20 rupees, 30 rupees, it is not worth it for the merchant also to accept that. So, what these players have doing, one approach they are taking is they will do the transaction on behalf of the merchant towards the credit card company. They aggregate them. Every 10-20 transactions they will aggregate and present it to the back end channel, whether it be a credit card company or a bank's online system, what have you. This is called the aggregation approach. They let the merchants accept very small payments using a traditional channel like a credit card. These companies take those transactions, aggregate them, put them together, make it big enough to be presented to the parent company, whether it be a credit card or a bank or what have you. For this they charge. The advantage for the merchants is they do not have to pay all the setup costs. They do not have to sign up with a credit card company with all the setup costs of the initial gateway and then the swiper and various costs. As customers come in, they can use one of these products to take credit cards online. As they come in, accept credit card payments without having signed up with the credit card company or the bank or what have you. So, this is called aggregation approach. One company is very well known for this, it is called Square, it is very popular for this purpose. it works with traditional channels like credit cards, online banking and things like that. It allows customers to make very small payments. So, I can go to a corner store, or in the US something like 1111, I can buy a piece of gum and say a box of cookies costing $1.39, and I use my credit card for that. Normally the merchant would not have accepted that, but using Square, we will see how Square works. I actually still swipe my credit card, make the payment, and the merchant without a swiper can still accept my credit card and get paid. Square takes the mediation between small transactions here and the big transaction expected by the back-end network provider. So, they bunch together a number of payments into one single transaction with a credit card network, bank or whatever. It reduces investment point of system. The merchants actually do not have to have any hardware with them to work with this. They do not even need to have a server, they do not need to have all the connectivity, things like that. So, this company, how does it transmit this data? What is the infrastructure it uses? It uses your phone network, which is already there. The merchant has a phone, I have a phone. It uses the phone network and phone's data. The infrastructure is already there. We do not need to buy any other hardware. It works with that network to enable credit card transactions. In fact, one of the attractions today, more than aggregation of Square, is that it enables mobile payments anywhere. It enables mobile credit card payments anywhere. We will see how. So, okay. So, I also need to briefly talk about it. This is the way Square works. Square gives this little device. See this little device here, Square, the word Square comes from that. It is called a dongle, something which fits into one of your jacks. It fits into the audio jack of your smartphone. It can fit to the customer's smartphone or to the merchant's smartphone. Let us say it fits into the merchant's smartphone. Square provides this dongle for free. Whoever signs up with Square, it provides the dongle for free. So, the merchant can charge. Suppose a merchant is delivering at home, they are delivering groceries at home. They can bring the dongle along with them, bring their mobile, swipe my credit card in front of my home. I do not have to go to the shop also. I do not have to go to the establishment to use my credit card. I use my credit card at home and they get paid. The transaction gets completed, it gets cleared, settled as per the rules and norms, and the merchant gets paid. So, it has made even credit card payments highly mobile. The first time I saw this was a group of one of the local mechanics wanted to sell a subscription plan. Like, you give us 5,000 rupees, I will do this maintenance over the next year for free. They went from door to door signing up customers. That is when I saw this in India. So, I said, do you accept a credit card? They said yes. So, where is the swiper? So, they pulled out the phone, put this dongle, swipe, done. So, it has made even traditional payment systems like credit cards mobile, run on the mobile platform. In fact, that has become the biggest attraction rather than micropayment itself. So, Square, like a credit card company, how does it work? It takes a cut of the transaction, 2.75% per swipe or 3.75% plus 15% for manually typed transactions. As you can see, this is a bit on the higher side. Even credit card, sometimes card companies only charge 2%, Square charges a slightly higher amount, but it brings us convenience. I do not have to invest in any hardware. I can use my mobile phone as the device to accept credit card payments by swiping them, and I do not have to pay for that. So, and I can charge it. One more example that has been given is that roadside assistance. You know, many companies in India too are offering roadside assistance. When my car breaks down, when I am traveling between two cities, so in the middle of nowhere, I can call one of these companies. They come with some equipment, fix my vehicle or tow it to the nearest center and then have it fixed, and let me continue my journey. So, if they fix it on the road, they can still accept a credit card because they can bring the dongle with them and accept it wherever they want. In fact, one of the most famous case studies in Square is based on this example. Okay. So, the payment processing, like every other payment processing, the seller puts the dongle at the point of sale, the buyer swipes the credit card. This simple dongle is what is called a payment service provider. It contacts the merchant's bank, the merchant's bank contacts the credit network, the credit network contacts the issuing bank, the issuing bank comes back with the approval. It checks with the bank who has issued the credit card, comes back to the device saying that this transaction is approved. So, then the money gets deducted to rather charged to the buyer's credit card, and the buyer gets a digital receipt. At the same time, the issuing bank provides the fund to this organization or to the acquirer, and that fund gets deposited to the seller, and I get a bill from the credit card. Like most processing, I swipe, all the clearance and settlement happens in the background. First clearance approval happens. Once the approval happens, the actual charging happens, it gets cleared, gets approved, money gets deposited in the merchant's account, and I get a bill. Very similar, except that for big parts of it, it uses the mobile network to do the transactions. The seller inputs the transaction into square point of sale, the dongle, at point, and presents the buyer with the amount owed. The buyer pays for the transaction by swiping or dipping their payment card on the square reader or the square stand, which captures the buyer's account information. The square point of sale sends the payment transaction information to Square, which acts as the payment service provider. It is not a credit card, it is not the issuer, or it is not the acquirer, it is a third party called a payment service provider. Square passes the payment transaction information to the acquiring processor via an internet connection. Square pays a small fee per transaction to the acquiring process. It charges 2.75%, part of it charges whatever the credit card company charges as its share of the commission. That is one approach, that is we use an existing infrastructure, existing mechanisms which are meant for high value transactions, but we make it mobile, we make it possible for micropayments by aggregating them. This is one approach, work with existing systems, and I have seen Square dongle in quite a few places in India, but not very common. Many of you may not have heard of it, but it has become widely popular in the western countries, especially US. It has become highly popular because they already had a very extensive network of credit cards and debit cards. So, Square naturally fitted into that phenomenon or that state of existence. The other approach is a traditional P2P approach that we have seen with Paytm, Google Pay, Amazon Pay, MobiKwik, Phone Pay, M-Pesa. These are all examples of a traditional P2P. Since they work on mobile, so many of the problems are already solved. They are available everywhere. There is no cost involved in setting up the hardware, very easy to set up the whole system itself, and the costs are reduced because these systems leverage the existing infrastructure of the mobile network itself. And on the back end, they either work with the e-wallet. We know there are 4 types of e-wallet, and some of these players can introduce what are called semi-closed e-wallets. I put X amount of money onto that from a bank, transfer it from a bank, and wherever I use it, those sales get charged into the money against the e-wallet. Or if I have not done my KYC, that money, the moment I charge it, that money gets charged to my bank account immediately, though this P2P system acts like a mobile debit card. So, they have already solved this problem of accessibility, wherever we are we can pay. So, they have, and on top of it, thanks to their very low cost of transactions, they are also very amenable to micropayments. And within those based on cryptocurrencies are even more suitable for micropayments. I have an example here, I will discuss that. So, we can go back to the P2P, you can go back to the lecture on P2P systems and see how they do it, what is the advantages, disadvantages. On top of it, using cryptocurrencies, they can make very small payments too, which we cannot imagine right now. So, P2P systems leverage existing infrastructure. They use the mobile transmission networks, mobile data. So, the cost of transactions is quite low, transactions are instantaneous. It may not be true with Square though, and the cost of record keeping is also very low. Many of these payment systems we know, P2P payment systems are working on the blockchain now. So, cost of keeping the ledger is close to 0, blockchain is the ledger, anybody can go and see them. There are certain problems because it makes it too open and too public, but the cost of keeping those records, earlier we used to have an array of accountants and various systems, accounting systems to keep track of. Here the track of records are kept on the blockchain. Among these, cryptocurrencies are even more suitable for micropayments. One is transactions are instant, like any other, most of the other transactions, cryptocurrency transactions are especially instant. They happen on the network. The moment that transaction gets mined, remember somebody has to mine those transactions, put them in a block and put them on the blockchain. The moment the transaction gets approved and gets mined, money will get deposited. In fact, at approval itself it will get deposited, but the record keeping happens immediately once the block is mined. Second thing is, cryptocurrencies are highly divisible. Let us take an example and see what it means. Say I do read the Wall Street Journal. Once in a while I do read their online version. Now Wall Street Journal, being in India, it is an American newspaper being printed out of New York. It is put behind a system called a paywall. To read any article, if I click on that article, say I am interested in what Wall Street Journal is writing about Indian business. So there is some article about new investment by Aramco into Reliance. I want to read that report. If I click on it, it only shows me the headline and some lines. If I need to read the whole article, I have to buy a subscription, which costs maybe $15 a month, $20 a month, which is quite expensive for somebody in India. For even somebody in US it is not cheap, but for me to read this one particular article or those articles pertaining to India, maybe in a month there may be 10 articles, maybe 15 articles, I have to pay $20 every month to get the subscription. They are making various other deals secondary. In sum, I have to buy this subscription to read one particular article, and maybe I am willing to pay 5 cents, the equivalent of 5 cents. Today I have no way of paying that. Neither Wall Street Journal has a way of accepting 5 cents from me for that one article, nor do I have a way of paying 5 cents to Wall Street Journal. Here let us consider Bitcoin. If Wall Street Journal were to accept Bitcoin as a payment, consider what happens. A Bitcoin can be divisible into 1 by 100 millionth. That means the lowest unit that the Bitcoin algorithm can keep track of is point followed by 8 zeros 1 Bitcoin. So if you do the conversion, the current value of Bitcoin is about $50,000. So this amount which is recorded, the Bitcoin algorithm, Bitcoin ledger, blockchain can keep track of this smaller currency. The value of this comes to 0.05 cents. So it can go back. We need 20 of these currencies to make up even 1 cent. So if I give 100 of this particular unit of Bitcoin, some of the people have suggested that this unit be called a Satoshi, named after the founder, the inventor of Bitcoin. 1 point followed by 8 zeros 1, 100 millionth of a part is possible to keep track of it in Bitcoin or Satoshi, and that is today equivalent to approximately 5 cents. To give 0.05 cents, so to pay for an article which costs 5 cents, all I have to do is to transfer 100 Satoshis. That comes to 1 followed by 7 zeros, 1 article in Bitcoin is equal to 5 cents. To pay 5 cents, I do 1 followed by 5 zeros, 2 Bitcoins. Actually it is 10 cents 1. It should be here. I have done my math wrong. So to pay 100 Satoshis, which comes to point followed by 5 zeros 1 Bitcoin. With that I can, if Wall Street Journal accepts Bitcoin, they can, because these amounts can be accumulated over a period of time. I can only download those articles which I want to read and pay for that on an article by article basis. So this is how micropayments work. And now think about it, many of us are not reading because we do not want to pay for all the other articles which I may not be interested in. For example, I know Wall Street Journal very regularly every week has one column on wines as part of their cultural part of the paper. I am not interested in that, I do not want to pay for that. Whereas people might be willing to pay only for that, and they may not be interested in the finance part of it or in the derivatives part of it, what have you. So the audience can expand like anything. Or those who are interested, now number of people who are interested in different things. Now Wall Street Journal does not have to offer a buffet. It can offer according to the menu. It gives us a menu, read all articles in India, pay 5 cents. Read all articles about wine, maybe there are less articles, pay 10 cents. So they can have like a menu of different offerings. I will only read that part and pay very small amounts like 5 cents. And they can keep track of this small amount because cryptocurrencies are so highly divisible. So, this is the beauty of micropayments, and why cryptocurrencies are very suitable for micropayments, because how divisible they are. So, to provide 5 cents, I pay to download one article, point followed by 5 zeros, 1 of a Bitcoin. So, this is the other approach. One approach is the aggregation approach. We work with traditional systems, they want big volumes. We take small transactions, put them together, make into one big volume, and now we are providing mobile also on top of that. So, that is one approach, work with existing systems, take an aggregation approach. The other is the P2P payments approach, which normally works reasonably well for current currencies too, but cryptocurrencies are especially amenable for such a payment. So, there is much more to micropayments than this, and over a period of time it will become so commonplace that we do not even refer to them. Today micropayments there is a lot of research going on in this field, a lot of literature is coming out. For a period of time probably it becomes so commonplace that we do not even refer to that. So, with that I would like to move on to the last topic I wanted to cover, regulatory landscape. So, as I have been mentioning, cryptocurrencies or fintech in general, it does things in a different way. Number of transactions, for example, all the kind of checks and balances which are very useful when the transaction is $1,000, when the transaction is $5,000. Do we need to do, can we do those checks and balances for a transaction worth 20 rupees? So, should the same rules apply in both cases? Same rules of storage, same rules of disclosure. So, this has led to a lot of thinking, lot of churn in how do we regulate these organizations. There are those authorities we say they are financial companies, we should regulate them like financial companies. There are people who say these are technology companies, they should be regulated like technology companies, two different set of rules. In fact, many fintech companies themselves have said we are not financial companies, we are only platforms, we are technology platforms, regulate us like a technology company. There are various viewpoints in the world, not everybody has agreed with everything, but in general the moment seems to be that most of the central authorities responsible for regulation, we will see who are the main authorities for regulating fintech in India, they are moving to a sort of hybrid, that they are coming with new set of rules for these systems which treat them mostly as financial systems, but where necessary they give them some allowance in terms, because they are essentially fintech companies. That is the approach that most of the organizations are moving towards. Today, for example, who can sell a stock, who can buy a stock, who can buy options? The SEBI is the organization which controls these rules. They make these rules in terms of who can buy stocks, who can deal in stocks, who can be the brokers, what kind of accounts we can open, how do they keep those shares. Today we do not see our shares, right? There we have demat accounts, dematerialized accounts, we do not see our shares at all. If I buy 1000 shares of Reliance, I never see anything, I just see a number. So, where are the actually shares are kept? They are kept in depositories, for example. The NSDL is one of the places like that. So, all of them are kept in depositories. So, they make rules, SEBI makes rules in terms of finance. So, SEBI also stepping in and say, if I am buying these stocks online, what are the rules that apply? If I am using a fintech platform, like there are many today like Zerodha and all those things, if I buy my stocks and shares from them, how should they deal with my purchase and sale orders, because they are completely online as compared to the physical form which we used to follow earlier. So, that there are different bodies which they have taken different approaches to regulating this new phenomenon called fintech. How do we regulate cryptocurrencies? I discussed a little bit yesterday that they have different versions of legality of cryptocurrency. Countries which are very against the concept of cryptocurrency and a lack of control like India have pretty much banned the concept itself. They have not explicitly said you cannot own a cryptocurrency, but RBI at various points has said you cannot buy, you cannot sell, you cannot deal with them, things like that, because there is no control. Whereas there are countries where cryptocurrency is almost close to being legal tender, like their legal money. More and more countries are moving that way. Some countries are letting you pay government taxes. Instead of paying them using cash or using from a bank account, you can pay cryptocurrencies like Bitcoin. Now, it is almost like a legal tender. You can use it for paying government taxes, but to the best of my knowledge, no country accepts cryptocurrencies as full legal tender. It does not have the full rights like the regular currency. So, let us take a brief look at various approaches to regulations. So, this is the statement, we are not financial institutions, historically has been a core fintech mantra heard around the industry. Unconstrained by many regulatory requirements applicable to banks and other financial institutions, fintechs pride themselves on creating deep customer connections, navigating market trends agilely and creating disruption for traditional competitors. For example, all these P2P lending banks, they provide loans at a much cheaper rate compared to banks, and they use different measures for measuring collateral. So, by means of which they are trying to disrupt the traditional banking business. And today in India we have called payment banks, which are also online, they can accept deposits up to 1 lakh. So, how do we deal with this deposit? In the US, for example, there is something called Federal Deposit Insurance Corporation, it insures all your bank accounts up to $2,50,000. If I have put $500,000 in a bank, if the bank goes bankrupt, FDIC will pay me back up to $2,50,000. That is a federal deposit insurance, that is the insurance. That insurance is not available to P2P lenders in the US. For loans that they give, the deposits they may take, it is not available. So, that is the downside of fintech institutions not being treated as financial organizations. They give all these benefits, but there are also downsides. So, some of the fintech companies themselves are moving towards being asked to be treated as fintech companies. So, in India we will see what are the regulations for such non-banking financial institutions. Some of the fintech companies come under that. So, there are regulations guarding them as non-banking financial institutions. So, many of the fintech companies in India are registering themselves as NBFCs, so that they can get the benefit of the assurance of government regulations. However, regulators are viewing differently. Some countries they are treating them as regular financial organizations. The focus from the regulator's point of view, the thing with fintech is it is very new. We do not know how many of these companies will be there. What is the risk to customers' capital? Suppose there is an e-wallet company which has taken, if it goes bankrupt for whatever reason, now it may have 1 million customers, 10 lakh customers. Each customer may have an average of, even if they have 100 rupees, even if they have 100 rupees, it comes to 10 crore rupees lost. So, who is going to make good that capital? So, how are they going to be protected? Because we do not know, the field is too new. So, many banks are focusing, the regulators are focusing on reducing the risk to protect customers. And second thing, the fintech companies get so much information about you. Every time I use my credit card, every time I use my Square for that matter, every time I use my P2P, either Paytm, Google Pay or whatever it is, they have so much information about me. If I pay cash, nobody can trace where I paid. One of the reasons why governments do not like cash, but if I use one of these things, they can go to the finest detail and say where did I spend 20 rupees at what day, what time, what place. They have so much information about me. Do we really want that information? Suppose if somebody wants to compromise that information, they can track my movement. They can track where do I spend my money. Do I want that information to be released to whoever it is? If it is even for authorized agencies, if government wants to get that information, do I want government to know so much details about me? And forget the other case, if somebody hacks into that system, steals that information, look at the risk I am under. Somebody can monitor me, somebody can stalk me every step of my actions. So, regulators are focused on reducing risk to protect customers, and again, if a very big financial player goes down, all the other companies dealing with them will also go down. So, they also want to protect consumers and markets. However, some of the financial risks in fintech are similar to traditional institutions like loans, deposits. The risk in doing a P2P lending is same as regular lending, except that here the risk may be higher because collateral and the customers are not known. So, the challenge is for the regulators, but the thing is fintech is evolving very fast. It is creating a lot of wealth, lot of jobs, lot of opportunities, lot of products, making life much easier for a lot of us. So, the challenge for regulators is to make such regulations to minimize risk, at the same time do not stifle innovation. If the regulations become too strong, too constricting, they may stop innovation, they may reduce the innovation. So, different central organizations have done it with various degrees of success. In India, the key organizations as we see like RBI, they are trying to do with a fair amount of success. So, the World Bank has considered this issue and come up with a set of guidelines. So, let us briefly take a look at that. However, this particular document from World Bank looks at fintech from only one perspective, that is accessibility. Earlier banking, many people could not open bank accounts, they could not do online payments for example. Fintech has brought it practically to everyone. For example, the concept of Jan Dhan accounts, which has extended banking to everyone, has been made possible because of back end fintech support. The technologies in the back end have made such a thing possible. They have made the KYC possible in such a large scale. So, World Bank sees inclusion, financial inclusion it is called. If you go and see in literature, especially in social sciences and humanities, financial inclusion is a very hot topic of study today, and World Bank's perspective on regulation looks at inclusion. Fintech provides inclusion, but what are the risks in this process? So, keep that in mind when we see this document. So, fintech has enormous potential to expand financial access and inclusion, as I said. It results in improved coverage of access to financial services. Even if I go to a roadside person, I can still pay him online using my mobile. Enhanced efficiencies and reduced cost, and also risk management. Cost of transaction is low, I do not have to, the roadside merchant can accept my P2P payment using Paytm because the cost to him is very low, unlike in the case of a credit card or a check, whatever. And now these companies also have more information, they can also manage the risk better. And new and more tailored type of product, service and delivery channels. Now today delivery channel is the mobile. Tomorrow who knows, it may come to a watch like device. We may not even need a mobile. I wear a watch, I transfer money using the wallet, using that. So, potential of fintech to reimagine financial process and business models, enable new entrants and competition within. No need to say more, we have so many players today. Disaggregation, specialization, APIs, enable services to be more accessible, including through mobile networks, often at a lower cost. This platform mobile today has become our standard platform for communication using phone calls or various other means, for computing, a personal assistant, as well as now financial device. Leverage electronic data to tailor product design, reach new consumers, accurately price risks. With so much data, they can come up with new and new. There are so many apps today. There are apps to find out weather. So, I have made a hotel booking to be in a place tomorrow or day after. Tomorrow morning I check the weather in that place. If there is a possibility of high rain or snow, I can cancel. I can cancel my reservation well in advance, so that I do not find a penalty. So, I can use my device to do activities like that because of the amount of information they gather. So, as the World Bank sees, the key benefit that fintech has brought in, other than efficiencies and things like that, is inclusion. It has made these technologies available to the smallest of merchants, smallest of customers, but there are risks associated with that. So, here are the challenges. Leveraging the digital opportunity does not come without risk. The inclusion part of it, which is pushing the push towards fintech, it is a game changer. Exponential technologies, mobile, internet connectivity, cloud are some of the things which are making it accessible, cheaper, more efficient. Expand and enhance the offer. So, now I can not only use it to make mobile payments, I can also do shopping, I also get points, loyalty points. Reduce the cost of serving the bottom of the pyramid. Since they leverage existing net infrastructure and technologies, some of these have made accessible all the features of fintech to the smallest customer. Improve convenience, collection and analysis of data for enhanced customization. Now, as I said, it's an issue of concern that these companies are collecting so much data, but they can also use the data for good. For the lowest customers, the customers who charge the least, they may come with a plan attached to their mobile. They may give them some incentives to increase the number of transactions. For people who use it for big transactions, they may come up with some reward points which may not be available to the smaller customers. So, they can customize their product. If I constantly buy air tickets using my mobile, if they collect the data, they can share it with the airlines, and the airlines can come to me making me offers, like I buy a hotel with an airline ticket and get 20% off, things like that. The risks are potential risk to financial stability. If one such big player, one such P2P player, one such P2P lending player goes down, becomes bankrupt for whatever reason, whole financial system may be affected. Even other parts, because they would have borrowed money from the banks, banks would have borrowed money from the depositors, taken the money from depositors, the whole chain of command may be affected. Integrity, how do I make sure that the 20 rupees that I am charging goes in as 20? What if somebody comes in and changes it to 200 rupees, 2000 rupees? So, how do we protect the integrity of the data? And consumer protection. I have charged to this fellow who has come to sell something in front of my home. The moment I charge, he runs away with my money, does not give me the goods or services. So, how do we protect consumers against such small things also? Or the product given to me or shipped to me is a different one than what I ordered for. So, what is the restitution? What are the measures I can take to recover my money? This is one of the risks, and trade off between policy objectives. How to approach the inappropriate balance. So, how do we protect customers? How do we protect their rights? At the same time, how do we make sure that innovation keeps going? This is always a challenge that we need to consider as per the World Bank. Some of the risks and benefits. Although Fintech has the potential to rapidly expand financial access and inclusion, it also poses risks. Some of the risks: depositor and investor risk. We saw that is the risk in the case of P2P lending. Depositors may lose their money, or the investors may lose their money if the customers do not pay up. Regulatory and supervisory perimeter capacity. Fintech players may not fit with regulatory supervisory remits. Developing country supervisors have systems and capacity constraints. Some advanced countries may have the capability to monitor all the transactions of all the Fintech companies, they may allow them. In countries which may not be as advanced, governments may not be able to monitor all the transactions, they may not allow these transactions. So, if a product is released in one such country, the risk is it may be disallowed. The governments in those countries may not allow these players. There is an example from the social media. Recently, Nigeria banned Twitter, just like that. So, they may ban Google Play also tomorrow, depending on what the contingent conditions are. So, in many of the countries there are regulatory risks to players. Fraud, other market abuses. Access to consumer information can lead to abuse without adequate consumer protection mechanisms. Cryptocurrencies can be used for illicit activities. This is always a danger with cryptocurrencies, the reason why many governments are reluctant to allow them, because it can be used for illegal activities. Risk of a cyber attack, it is always there. In fact, there are famous case studies where entire countries like Lithuania, it is a very advanced country in Fintech, hackers from another country attacked this system and brought their entire financial system, including the central bank, down for 2 weeks. So, no transactions could happen except cash. So, such things are possible. Financial stability. Unsupervised linkages exacerbates credit cycles, untested credit models affect banking system profitability. If loans are not get paid, if there are too many bad loans, banks will go down, they take everybody down with them. One example. Over indebtedness. It becomes too easy to borrow, people may borrow a lot. New easier access to digital credit may cause borrowers to be more susceptible, particularly without adequate financial capability. If the lenders do not check for collateral properly, or if the methods they are using are wrong, borrowers may borrow too much beyond their capacity, they may not be able to pay, either they apply for bankruptcy and lenders will lose their money. These are some of the risks with Fintech. So, this is a chart which is comparing the level of regulatory involvement against amount of enablement. The path is take a middle path between them, take a middle path, do not over regulate, at the same time do not allow any kind of experimentation, allow reasonable amount of experimentation. One way to do that is like a sandbox. One of the approaches which RBI also has executed, RBI has published a standard, it has published which has created a number of sandboxes depending on the various products. If somebody wants to introduce a new product which we want to test, RBI wants to test, it has certain conditions. The company should have so much capital, this is a new product which is filling a gap in the market. If we convince RBI that our product fits into that, RBI gives us a set of systems and an infrastructure for us to test the products without current rules applying. For a test pilot period, we can make new ways of lending possible, new ways of payment possible. even if they are breaking the current regulations. But it is done in a very controlled fashion to see if the benefits of this product are so good that we need to modify the regulations, RBI will modify the regulations to accommodate this. Or if the product is too risky, RBI may say, good, you tried this product, go home, it will not work. So, this sandbox approach is a good approach in between that the World Bank has recommended for various regulatory authorities to make sure that new constant innovation happens. At the same time, we regulate them properly if they bring unnecessary risks to consumers, markets and other players. So, this another approach is case by case, look at each case and give them permission, things like that. It has different approaches. This is what is called a structured experimental approach. This is something that even RBI, Reserve Bank of India in India, has adopted. They have given simple actions. Establish policy windows to prioritize adjustment of legal regulatory framework, specifically for fintech innovations that enhance in financial inclusion. So, set up a different way of policy making to evaluate fintech. Do not go through your regular approval process. To make it faster, establish separate setup safe to come up with regulations for fintech. Establish committees, working groups to monitor fintech for financial inclusion. For example, if a fintech product requires certain high level of smartphone, features available only in the high end smartphones and does not work on any other smartphone or any other phone, it is exclusionary by nature, it does not include everyone. So, such a thing may not get approval. So, evaluate each of these products to see are they available to the lowest customers in the market and then approve based. Remember, the World Bank's paper was based on inclusion. Explore establishing a structured experimental approach like a sandbox or even accelerators, hubs specifically to encourage development of innovations in financial inclusion. This is the approach that many countries have taken. RBI has published an entire set of guidelines on setting up. In addition, RBI also has set up quite a few sandboxes where products can be tried. So, World Bank has come with a set of recommendations. They are coming with a perspective of inclusion, financial inclusion, but those policies can be reasonably adopted for every other purpose of regulation also. And they have given some examples of how innovations have been adopted to increase inclusion. So, some of the other points they say, policymakers today cannot afford to remain inactive with fintech. Fintech is going advanced, regulators have to catch up. They have suggested some minimum actions. One is make it regulator centric. Regulation should be there. Make sure and make it market watch task force. That means there is a task force which constantly watches what is happening in the market and comes up with new and new regulations to monitor that. Inter-regulatory finances committee. Like I said, in India we have so many agencies like SEBI for stocks, then we have NPCI for online payments and various other organizations, enforcement directorate in other financial matters, especially legal. Then we have RBI itself. World Bank says set up an agency to coordinate with all of them, interagency regulatory committee. Okay. Sectoral stakeholder forum, also talk to the stakeholders. If somebody is coming with P2P lending, form a committee with the platform. Who are the players? Lenders, platform, borrowers, form a forum to take feedback from all of them. So, it has come up with a set of good recommendations, generally good practices which could be adopted everywhere, and it has given a few examples of fintech, how fintech is helping with inclusion. One of the examples they have given is a matter of pride for us, it is Aadhaar. They have said Aadhaar is now a tool for inclusion in India. Thanks to Aadhaar, KYC requirements have been reduced. Thanks to Aadhaar, now that we have Jan Dhan accounts. Jan Dhan accounts was made possible on such a mass scale because of Aadhaar, which is a key element of inclusion today. Lot of direct deposit of benefits to beneficiaries in India. Earlier it used to go through various intermediaries, and there have been famous statements about what percent of it gets siphoned away, what reaches them. Now, thanks to direct benefit transfers, hundreds of millions of beneficiaries are seeing the benefit directly deposited to their account, whether PM Kisan Yojana and various things like that. So, the example they have given is the digital ID case of Aadhaar. eKYC, earlier we had to produce documents, PAN card, photo, all those things. With Aadhaar authentication sufficient for opening basic bank accounts and was central to the mass account opening campaign PM JDY, Pradhan Mantri Jan Dhan Yojana, over 50 million accounts in open in 2 years. So many bank accounts could be opened because KYC, know your customer process was made simpler using Aadhaar, because Aadhaar was acting as a KYC. Government to person, deduplication and targeting of government subsidies and making Aadhaar the payment address, enabling paying subsidies by mapping Aadhaar number to bank account. So, public distribution system, LPG cylinders, social security net programs. Earlier customers had to go there with a set of documents to collect these benefits. Now, thanks to Aadhaar and Aadhaar being linked to their bank system, these benefits can be directly deposited to their accounts. PM Kisan Yojana being one good example. Aadhaar based authentication of payment transactions and digitally signing legal documents. So many places you accept Aadhaar as the key document to prove our identity, for example. Anywhere we can use Aadhaar as our key identity. We do not need a passport, we do not need a driver's license. Aadhaar can be used for digital local service, mobile based, intended to provide secure access to government issued documents and released based on approval of individuals. I can save all my legal documents in my wallet, in my passport, using Aadhaar, using this digital local service, locker service. When this document was written, there were 4.2 million users, 6 million uploads were there, 1.56 billion documents were stored in such digital lockers. So, with that we will briefly take a look at Indian agencies. The agencies involved with regulation in Fintech in India are RBI, National Payment Commission of India NPCI, a concept called Ombudsman for digital transactions, and the United Identity Association, which issues Aadhaar. So, Reserve Bank of India is the primary regulator. Most of the regulators come from RBI or under RBI guidelines. RBI has been constantly monitoring and issuing, keeping update with all aspects of Fintech, including creating sandboxes. NPCI is the Payment Commission. It is a joint initiative of RBI and Indian Banks Association. It acts as a quasi regulatory agency for retail payments and settlement systems. NPCI is the one which has developed UPI, which has made so much innovation possible on the Fintech area. RBI has also mandated Ombudsman for major Fintech players. It appoints an officer who acts as an agency to hear customer complaints. RBI said you appoint your own people, did not happen. Now, RBI appoints supervisory officers called Ombudsmen. They act as a point for Fintech and non-bank companies to address consumer complaints, including deficiency of service, unauthorized transfers, failure to initiate refunds. So, when we have complaints about all these things, consumers can complain to the Ombudsman monitoring that particular field. UIDAI is the organization monitors the implementation of Aadhaar, responsible for Aadhaar program, governs the user of Aadhaar by Fintech players. It says who can use Aadhaar for KYC, for verifying the identity of the customer. It has made rules and regulations to monitor their users to make sure that Aadhaar is not misused. Some of the key regulations, I will not go into details due to shortage of time. Just be aware that there is a whole series of regulations. There is one thing called Payment and Settlement System Act 2007. This applies to P2P payments also, all kinds of online payments including credit cards, debit cards, smart cards, money transfer systems, P2P, PPI, payment instruments. They all have to follow the regulations to protect the customer and all the other benefits. They have to follow this act. Within that, there is an additional act called Master Direction on Issue and Operation of PPI. E-wallet companies have to follow this. They have to follow this in addition to PSS Act. Then NPCI has a set of guidelines for UPI payments. There are guidelines regulating P2P lending platforms, which says who are the lenders, how much exposure can take, they can take, how much borrowers can borrow, what is the maximum can borrow. Those limitations have been set under this act. There are acts to control money laundering, bunch of activities. Now, there are also actions coming to protect data. Who can store the data? For example, government is forcing all foreign financial institutions to store their data on Indian customers on Indian servers in India. That comes under this act. It is still under being negotiated, not fully enforced, but such acts are coming into play. So, every aspect of Fintech is being regulated. Here are some of the effects on them. For example, we know that currently people who issue e-wallets, private organizations other than banks. Banks can issue all types, open, semi-open, closed and semi-closed. whereas specific types of PPI, private organizations, Paytm for example, can issue only semi closed wallet. So, there are regulations happening all around, more and more are coming. This is just to give a flavor of who the regulations are, what kind of regulations, how does it affect fintech players. I hope with that we come to the end of this lecture, also the end of this series. It is a very vast subject, 10 hours is nowhere close to the requirement we have, but I hope all of you have gotten an idea. When we say fintech, what does it mean? How does it affect me? What are the opportunities? Who are the players? When I hear names, where do they fit in? What are the regulations? What are some of the technologies? If you have gotten a basic idea of these concepts and ideas and phenomena, our purpose is well served. So, with that we come to the end of this series. This lecture is being broadcast on channel 16 Swayam Prabha program. Thank you for joining us.